Stock Talk listeners, welcome back. We're doing another deep dive today.
Yep, getting into the weeds.
Exactly. And hey, if you find this kind of analysis useful, maybe take a second to like and subscribe. It genuinely helps us make more of these.
It really does. But first, we absolutely need to get the legal stuff out of the way.
Right, the necessary bit. Go ahead.
Okay, disclaimer. This investment thesis is for informational purposes only and does not constitute investment advice. The analysis reflects the author's opinions based on publicly available information as of May 26, 2025.
Got it.
Turnaround investments carry significant risks, and investors should conduct their own due diligence or consult a licensed financial advisor.
Always good advice.
And remember, past performance does not guarantee future results, and all investments carry risk of loss.
Okay, crucial points covered. So let's jump in. Today, we are digging into a bunch of sources all about the Estée Lauder Companies, Inc. You know, ticker EL.
That's the one. And specifically, we're looking at an investment thesis that's floating around analyzing its potential as, well, a turnaround story.
Yeah, turnaround play. So what kind of sources are we pulling from here?
We got a mix. Recent SEC filings from Estée Lauder itself, their latest earnings reports, which are key.
Naturally.
Plus some industry research, context on the beauty market, and of course, current market data.
Okay, so our goal here, our mission for this deep dive is really to sift through all that stuff, pull out the most important bits about where Estée Lauder stands right now, the real challenges they're up against.
Which seem pretty significant.
Definitely. And also the plan they've put together to try and fix things, basically help you, the listener, get up to speed quickly on this whole complex situation.
Right. So let's start with the main idea from the analysis we looked at. The core thesis is framing Estée Lauder as a potential deep value turnaround play.
Okay, deep value turnaround play. That phrase itself tells you a lot, doesn't it? Something's obviously gone wrong for it to be deep value.
Exactly. It means the company is facing some serious headwinds, and that's reflected in the stock price, but the source thinks there's a path back.
And it's positioned as a bit of a contrarian take for patient folks.
Yeah, definitely not for the faint of heart or those looking for a quick win. Patience is key here. The specific recommendation is actually a cautious hold.
Cautious hold, okay. And what kind of price target are they suggesting?
The analysis points towards a $75 to $85 range.
Yeah.
But over the next, 12 to 24 months. So not immediate fireworks expected.
Right. That timeline reinforces the patience needed part. So cautious hold, $75, $85 target. What makes the valuation look like deep value right now? Let's get into the numbers.
Okay, so the stock's trading around $66.08 as of the source date. But the really eye-popping number is the drop from its peak back in 2021.
How bad is this?
It's down a whopping 78%. 78%.
Wow. Okay, that's a massive haircut. No wonder they're calling it depth value.
Exactly. And you see that reflected in the price-to-sales ratio, too. It's currently only 1.5 times sales.
1.5x. How does that compare to others in the industry?
Well, the peer average mentioned in the source is around 3.1 times sales. So, yeah, visually it looks really cheap on a relative basis.
So trading at half the multiple of its competitors, that's the hook for the value argument. But the sources are pretty clear. This isn't just the market missing something, right?
Absolutely not. The analysis stresses that point. That low 1.5x PS isn't some hidden gem signal. It's a direct reflection of very real operational problems and market difficulties the company is facing.
Right. The market cap tells that story, too, down to, $23.5 billion?
Yeah, from over $40 billion when things were flying high. It's a big drop.
And these operational problems, they're hitting the bottom line hard. I saw the trailing 12 months operator margin. It was actually negative.
Yeah, negative 3.6%. Compare that to the previous year when it was positive 10.2%. That swing really shows the impact.
And a negative operating margin means?
Means they've been losing money recently, which is why the PE ratio is negative, too. It really highlights just how deep the operational struggle has been.
The sources also mentioned the dividend. The yield is 2.15% now, but that's after a cut, wasn't it?
It was. They cut the annual dividend down to $1.40 per share. Now, obviously, that's tough for income investors.
Yeah.
But the analysis kind of frames it as a necessary evil, a strategic move, painful maybe, but it gives management more financial breathing room, more flexibility to actually fund this turnaround plan.
Right. Conserving cash is paramount in these situations. And what's the general feeling on Wall Street? What are the analysts saying?
The consensus seems to be generally hold. Their average price targets are mostly clustered around the $68 to $75 mark.
So basically around where it's trading now or maybe slightly higher.
Exactly. But the sources also point out there's a really wide range in those analyst targets. Some are higher, some lower.
Which tells you what?
It just underlines the uncertainty, right?
Hmm.
The market isn't really sure how quickly or even if this recovery will happen and how strong it will be.
Okay, so we've got this iconic prestige company that's been hammered, looks cheap based on sales, but has serious profit issues, dividend cut. Analysts are kind of sitting on the fence. What's management actually doing about it? What's the plan?
Okay, so that brings us to their big strategic push, the Profit Recovery and Growth Plan, the PRGP.
PRGP, catchy acronym.
Well, the sources describe it as this really comprehensive strategy designed specifically to tackle the biggest operational and cost challenges they're facing head-on.
And the headline number for this plan? The financial target.
It's pretty ambitious. They're aiming for $800 million to $1 billion in incremental operating profit improvement.
Wow, up to $1 billion. That's significant. How are they planning to achieve that kind of number?
It breaks down into a few key areas. One major piece is workforce optimization.
Meaning layoffs.
Yeah, unfortunately. Reducing headcount globally by about 5,800 to 7,000 positions. That's roughly 9 to 11% of their workforce.
That's a big cut. What else is in the plan?
They're also focused on transforming the supply chain, trying to get more efficient, aiming for zero waste,
Yeah, okay.
and importantly, getting better at demand forecasting, trying to match what they make more closely to what people are actually buying.
Makes sense. Avoid getting stuck with inventory. Anything else?
Yeah, procurement consolidation is another one. Basically, looking hard at all the supplier deals and trying to bundle spending to get better prices.
Right, squeezing costs wherever they can.
Exactly. And the last piece mentioned is service outsourcing. Partnering up with specialized global companies for some internal services, again, hoping for better efficiency and lower costs.
So it sounds like a really deep operational overhaul. Cost cutting, efficiency drives across the board.
Yeah.
And who's leading this charge now? There's new leadership, right?
Yes, the CEO is Stéphane de la Faverie. Now, he's not entirely new to the company. He's been with Estée Lauder since 2014.
Okay, so he knows the business.
Right. But stepping into the top job brings a fresh perspective. His big strategic vision is called Beauty Reimagined.
Beauty reimagined. Sounds aspirational. What does that actually mean in practice?
Well, according to the sources, it involves a few things. Accelerating how they reach consumers, pushing for more transformative product innovation.
So R&D focus.
Seems like it. Also, boosting investments in things like marketing, the stuff consumers actually see, and underpinning all of that growth is enabling it through operational efficiencies.
Which ties right back into that PRGP plan.
Exactly. It all links together. New vision, supported by this big operational restructuring plan.
Okay, so new CEO, big plan with big targets. Are we seeing any green shoots yet? Any early signs that this PRGP thing is actually starting to work, even a little?
The sources are careful to say it's still very early days for the PRGP implementation.
Understandable.
But they do point to a couple of, let's say, initial positive indicators. One specific area is gross margin.
Ah, okay. What's happening there? How much did it improve?
In the most recent quarter mentioned, Q3 2025, the gross margin hit 75.0%.
And what was it before?
It was 71.9% in the same quarter the previous year. So a noticeable improvement.
And what's driving that, according to the sources?
Mostly attributed to better manufacturing cost efficiencies.
Yeah.
And, importantly, lower charges for obsolete inventory.
Which connects back to those supply chain and forecasting improvements they're aiming for.
Precisely. So you can see a potential link there.
Okay, so that's good news on the gross margin front. They're making things more efficiently, managing inventory better. But has that actually flowed through to the overall results yet? Made the company more profitable overall?
And that's but the analysis really emphasizes. While those gross margin gains are definitely a positive sign at that level,
Yeah.
they've basically been wiped out or offset by two things.
Mm-hmm.
Continued declines in overall revenue and the significant costs tied to actually implementing the restructuring plan itself.
Ah, okay. So restructuring isn't free.
Not at all. So you see some operational progress in one area,
Yeah.
but the top line is still shrinking and the cost of the fix are weighing things down. The big picture is still pretty messy.
Right. Which brings us squarely to those market challenges. The sources paint a pretty tough picture of the environment Estée Lauder is operating in. What are the main headwinds?
There's several big ones. A major issue highlighted is weakness in the China market. That's been a huge growth driver for them historically.
And now?
Now they're seeing pretty significant revenue drops, both in mainland China itself and, crucially, in the Asia travel retail channel, duty-free shops and airports.
Why the slump in China specifically? Is it just the overall economy slowing down there?
That's part of it, yeah. Consumer sentiment is generally more subdued. People are maybe being a bit more cautious with spending on luxury goods.
Okay.
But it's more complex than just that. There's also less travel by Chinese tourists compared to pre-pandemic levels, which directly hits that travel retail business hard. And then there are strategic factors too. Estée Lauder has apparently made conscious decisions to pull back from certain reseller activities, sometimes called the daigou market. Plus, the retailers themselves are changing their models, maybe focusing on different duty-free setups that are more profitable for them.
So it's a combination of macro factors, consumer behavior changes, and shifts in the actual business channels. A perfect storm almost.
Kind of, yeah. And it's not just China. What about competitive pressures?
Oh, yeah, that's another big theme. The sources say competition is heating up from all angles.
Like what? Well, you've got mass market brands like ELF Beauty is mentioned specifically, really gaining ground and attracting consumers who are maybe more price sensitive now?
Right, trading down, potentially.
Could be. And the places people buy beauty are changing too. Traditional department stores, which used to be the stronghold for prestige brands like Estée Lauder, are losing ground to specialty retailers like Sephora or Ulta.
And I bet local brands are getting stronger too, especially in places like China.
Absolutely. The rise of local Chinese beauty brands is a growing challenge for all the big international players. Plus, there's this shift towards what they call open cell retail formats, where customers can browse and test products more freely.
That's Sephora, yeah.
Exactly. That's more popular with younger consumers, and it requires a different strategy than the old school counter model.
So tough market, tough competition. And the sources also mention problems within Estee Lauder's own brand portfolio. Something about impairment charges.
Yes, that was a significant point. They took impairment charges recently, totaling $861 million.
Wow, nearly $1 billion. On which brands?
Specifically called out were Tom Ford and Too Faced.
And what does an impairment charge like that signal?
The analysis basically interprets it as a clear sign of execution problems with those specific brands. Something isn't working as expected.
What's the issue with Tom Ford and Too Faced, according to the sources?
Well, Tom Ford is apparently struggling in key markets. China and North America were mentioned, not getting the traction they hoped for. And Too Faced is reportedly losing market share. The makeup category is just incredibly competitive, and it seems they're falling behind.
So this highlights a need to maybe rethink the portfolio, focus resources.
Definitely. It underscores the need for some serious portfolio optimization. Management needs to figure out which brands deserve the investment, which might need fixing, and maybe even which ones don't fit anymore.
And what's interesting or maybe concerning is that the sources say the overall market for prestige beauty isn't actually shrinking, right?
That's a critical point. The overall global prestige beauty market is still growing, estimated at around 7%. Fragrance is doing even better, up like 12%.
So Estee Lauder's problem isn't that the tide is going out for everyone.
No, the tide is still rising. Their specific challenge is that they seem to be losing share within that growing market. It's about competitive execution, adapting to those channel shifts, and fixing the issues in specific brands and regions to capture their fair share of that growth again.
Okay, let's shift gears slightly and look at the company's financial health. The balance sheet, cash flow. What's the story there?
All right, so top line, the trailing 12 months revenue was $14.8 billion. But crucially, the trend has been downward.
Declining revenue. Okay. What about the balance sheet? Cash versus debt.
This is where it gets interesting. They have a net debt position, about $2.6 billion in cash, but $9.4 billion in total debt.
So doing the math, that's a net debt of $6.8 billion.
Exactly. $6.8 billion in net debt.
That sounds like quite a bit of leverage.
It is. The sources flag the debt-to-equity ratio at 2.16, describing it as elevated.
And why is that a concern in a turnaround situation?
Well, high debt adds risk. It means more the cash they generate has to go towards paying interest, about $269 million annually right now, according to the source.
Wow.
That's cash that can't be reinvested in growth or used to accelerate the turnaround or provide a buffer if things take longer or get worse. Leverage magnifies both gains and losses.
Definitely something to keep a close eye on then. But are there financial bright spots? What strengths did the sources identify?
Yes, there are positives.
Oh.
A really important one is that despite all the operational issues, they are still generating positive free cash flow.
How much?
About $948 million in the last 12 months reported. That positive FCF is really a foundational strength, gives them something to work with.
Okay, that's good. Anything else?
They also have adequate liquidity, enough cash, and access to credit. And those gross margins we talked about earlier, while improving, are still fundamentally strong at around 73.9%.
Which suggests...
It suggests their brands still have pricing power. People are willing to pay a premium for brands like Estée Lauder or La Mer, even with the challenges, and they still have a very diversified business across categories and globally, even if China is weak right now.
Okay, so generating cash, strong brands with pricing power, diversification, those are clear pluses.
Yeah.
But balanced against the high debt and recent losses, how is management actually allocating capital with all this going on?
They've clearly shifted priorities towards preserving cash and shoring up the balance sheet.
Right.
We mentioned the dividend cut that saved over $150 million a year right there. Share buybacks are off the table for now, also to save cash. And they've trimmed capital expenditures, though they're still spending on essentials needed for the PRGP and innovation.
And the cash they are generating from operations, the free cash flow. What's the number 1 priority for that?
Debt reduction. The clear focus, especially as free cash flow hopefully improves with the PRGP, is to pay down that $6.8 billion debt pile. The sources kind of frame it as, the debt is high, yes, but the fact they're still generating cash gives them a pathway to manage it over time if the turnaround works.
Right, the big if. Okay, so putting it all together, the stock's been crushed, valuation looks low but reflects real problems, there's a big turnaround plan, significant debt but also cash flow. How does the analysis model the potential outcomes? What are the different scenarios they lay out?
Yeah, the source maps out 3 potential paths: a bull case, a base case, and a bear case, each with assigned probabilities.
Okay, let's start with the optimistic view. The bull case. What does that look like and what are the odds?
The bull case gets a 30% probability. This scenario assumes the turnaround plan, the PRGP, is executed really well. It hits those big targets, $800 million to $1 billion in savings.
Right.
It also relies on a significant recovery in the China market and sees operating margins expanding nicely, maybe back towards 15% or more.
And if all that happens, where could the stock go?
In that bull scenario, the analysis suggests the stock could potentially reach $100 to $120.
Okay, significant upside from the current $66.
Okay.
What needs to happen to trigger that? What are the catalysts?
You'd need to see clear proof of operational excellence from the PRGP savings actually materializing. A strong, sustained market recovery, especially in China and travel retail. Success in fixing or optimizing those underperforming brands. And then, importantly, the market regaining confidence in awarding the stock a higher valuation multiple again, maybe back to 2.0 or 2.5 times sales.
Got it. Now, what about the most likely scenario according to this analysis?
That's the base case, which they give a 50% probability. This assumes a more gradual improvement, modest margin recovery. The PRGP delivers some benefits, but maybe not the full $1 billion right away.
And the stock price in that scenario?
This is where that $75 to $85 target range comes in. The base case lands the stock there.
Okay, aligning with the cautious hold idea.
Yeah.
And then there's the downside, the bear case. What's the probability and what happens there?
The bear case gets a 20% probability. This is where the current challenges just persist, or maybe even get worse. Market share continues to erode.
What would drive that negative outcome?
Could be several things. Maybe a fundamental shift in consumer tastes away from traditional prestige beauty. Maybe the China market decline turns out to be structural, not cyclical. Maybe management just fails to execute the PRGP effectively. Or maybe competitors just keep eating their lunch, making some brands seem outdated, and the high debt load could become a real burden if profits don't recover.
What kind of price target does the bear case imply?
The analysis puts a $45 to $55 target on the bear case.
Still, even in that negative scenario, are there things that might stop it from falling even further? Some kind of floor?
Yeah, the sources mention some mitigating factors. Estée Lauder still owns incredibly valuable, iconic brands, even if some are struggling now. That portfolio has inherent worth.
True.
They are still generating that positive free cash flow, providing some cushion. They have a big global asset base. And there's always the possibility of an activist investor stepping in to force changes, or even a potential strategic buyer being interested if the price gets low enough.
Yeah.
These things offer some downside support, according to the analysis.
Okay, so bull base, bear scenarios laid out. Taking all that into account, let's circle back to the final investment recommendation from this analysis.
It stays that cautious hold, but with the addition of selective buying.
Selective buying. So why, after detailing all those risks and challenges, would the analysis suggest someone even consider buying the stock right now? What's the positive argument?
Well, the core arguments are, first, the deep value angle. That 1.5x sales multiple is historically very low for EL compared to its usual 3x or 4x.
Okay, the potential for mean reversion.
Kinda. Second, there is a comprehensive turnaround plan in place, the PRGP, with concrete, ambitious targets. It's not just wishful thinking, there's a roadmap. Third, you have new leadership trying to implement a fresh vision. And fourth, fundamentally, the brand portfolio is still strong and holds significant value, if they can execute this turnaround.
The upside could be substantial from this low valuation.
That's the argument. But, and this is a huge but, the analysis hammers home the risks. This is a high-risk turnaround.
So risk management is absolutely critical.
Essential. Things like sizing your position carefully, don't bet the farm. Monitoring progress, religiously watch those quarterly PRGP updates like a hawk. Keep tracking China, consumer sentiment, competitor moves, and as we said, be patient. This isn't likely a quick fix. Think 2-3 years.
So summing up the investment verdict from this particular source.
It's presented as a classic turnaround situation. Needs patience, needs risk tolerance. The problems are real, no doubt about it. But the valuation discount and the potential for improvement create what the analysis calls an asymmetric risk-reward, potentially more upside than downside. The CEO's vision and the PRGP give you the plan. Success hinges entirely on execution in a tough environment. That 75-85 at target represents maybe 15-30% upside over 1-2 years, assuming modest improvements. High risk, maybe suitable for a part of a portfolio that can handle that volatility.
Okay. Looking forward then, what are the specific milestones or catalysts the analysis suggests investors should really be watching for? What could move the needle?
They break it down nicely by time frame. In the near term, like the next 6 to 12 months, all eyes should be on the next couple of earnings reports, Q4 2025, Q1 2026.
Looking for what specifically?
Concrete proof that the PRGP is delivering actual cost savings that are hitting the numbers. Also, any improvement or even just stabilization in China, consumer spending, and travel retail. Any news on brand optimization decisions, are they fixing, selling, investing, and of course, any updates to management's own forecasts.
Makes sense. And then looking out a bit further, say 12 to 24 months, medium term.
That's when you'd hope to see the realization of those cost savings. Operating margins should be visibly improving, hopefully heading back towards more normal levels for them. You'd want to see revenue growth actually starting again in key markets, market share stabilizing, or maybe even ticking up slightly, and clear progress being made on paying down that debt.
And longer term, 24 months plus, what does success look like then?
That's the full turnaround playing out. The PRGP fully executed, the company back on a path of sustainable growth and profitability. The stock's valuation multiple expanding significantly as the market rewards the success. Maybe they even start talking about strategic alternatives again, or restoring the dividend fully. Basically, EL recognized again as a well-run, efficient leader in prestige beauty.
The source also briefly touched on a possible investment strategy framework for someone who accepts the cautious hold with selective buying idea.
Yeah, just briefly. It suggested maybe dollar cost averaging into a position, perhaps in that $60, $70 range. Focus monitoring on those key things. Earnings, PRGP, China, competition, planning for a potential 2-3 year hold.
Yeah.
And thinking about an exit maybe around $80, $90 if the base case plays out, or holding for more if the bull case starts looking real.
You know, this deep dive really brings home just how complex analyzing a company like Estée Lauder is at this moment.
For sure.
We've seen how a company with these incredibly powerful, well-known brands that still command premium prices.
Yeah, that gross margin is just impressive.
Right, how even they can get hit so hard by shifts in the market, by competitive pressures, by operational stumbles. It leads to this valuation that looks cheap, tempting even.
But reflects some really deep-seated issues they need to fix.
Exactly. And we've seen management's response, this ambitious PRGP plan, the new CEO's vision. But the path to actually executing that plan successfully in this kind of environment, it's anything but guaranteed.
No easy wins here.
It just shows how much value there is in digging into these sources, you know? Getting beyond the headlines to see the specifics of the PRGP targets, the different factors hurting the China business, the details of the balance sheet and debt load. You just don't get that from a quick glance.
Absolutely. It really boils down to weighing those very tangible risks, the market dynamics, the execution uncertainty against the potential reward offered by that low valuation, and the fact that they do have a clear plan, even if it's a difficult one.
So maybe a final thought for you, our listener, to chew on, building on this idea of fixing operations versus needing something more radical. When you look at a company like Estée Lauder, facing these challenges but relying heavily on its heritage brands and operational fixes, how do you decide if the problems are just temporary bumps that good management can smooth out, or if there's signs of deeper structural shifts in the industry or the company itself that might require more than just cost-cutting and efficiency drives. Where's that line?
That's often the multi-billion-dollar question in turnaround investing, isn't it? Getting that judgment right.
It really is. Well, thanks for joining us for this deep dive into the Estée Lauder situation.
Always interesting to unpack these complex stories.